All right. Hello, everybody, and welcome to Stablecoins Are Killing It. This is episode number 11. We've got a great show for you today, including Josh Frank from the Thai. Josh, welcome back.
Thanks for having me on, Lou.
Yeah, I think you're the second person now to have a second appearance on Stablecoins Are Killing It.
Well, I'm honored.
We've got an appearance from Macauley Peterson. Hi, Macauley.
Hi, glad to be making my first appearance.
And so, Josh, you're calling in from California, and Macauley, you're dialing in from Germany.
From Hamburg, yes.
From Hamburg. And I'm in New York. So this is truly a global show, and obviously stablecoins are global. We've had another big week in terms of growth. Stablecoins, according to the data that I've aggregated, now over $15 billion. It was about $10 billion when we started the show in April. So we're seeing really dramatic growth that seems to be accelerating, and obviously everything that's going on in DeFi is having a real positive impact on the use of stablecoins. And so we've got a great show. As always, we're going to leave time at the end. Josh and Macauley are each going to speak for about 10 minutes, and then we'll use the rest of the time for questions from the audience. So if you've got a question, you can put it into the chat function on Zoom. And if we pick your question, we will have you come up on stage. We'll open up your microphone, open up your video. You can join us as panelists on Zoom, ask your question, and really have a dialogue with the panelists. And so with that, we can start with the panelists. And we're going to start with Macauley. And so Macauley, I just need to make you a host so you can grab the screen. So now, Macauley, you are a host and can grab the screen. So with that, I'd like to turn it over to Macauley Peterson, who just finished writing his master's thesis on stablecoins.
Okay, should be good to go.
Yep.
All right, thanks. So yeah, I'm Macauley. I am relatively new to the space. Well, I've been following since 2017, but I've been having a career in professional chess as a media journalist for many years, and decided to try something new with a master's in law and business about a year ago. And so, yeah, this is a small part of my master thesis, which just kind of gives a little bit of a guide to my thinking on stablecoins and DeFi. So I'm going to start with a couple of assumptions, and this is kind of not things that I'm going to talk about in detail, but just that we need to take for granted. And then using the idea of Eurodollars, which is actually quite an old idea, at least going back to the 60s, as a metaphor for what we're seeing with stablecoins. And also this concept of narrow banks, which is an even older idea, actually, that has been bandied about at various times over the last 150 years at least, and how that might play into the central bank digital currencies. And lastly, just a little PSA from me as a veteran of YouTube webcasts. Okay, so first of all, I'm assuming that DeFi, which is now currently on Ethereum, will either be up on Ethereum 2 or an alternative stable base layer that is scalable. So right now, for example, we're seeing unprecedented high gas fees, which is kind of making a lot of DeFi operations more or less impossible, at least on relatively modest amounts of capital, which completely undermines the whole use case in the long run, unless that gets resolved. But I'm assuming that it's temporary. Also assuming that a lot of the DeFi protocols that are involved will be secure. That is to say that they will stop getting hacked on a regular basis after they're introduced, which is unfortunately still quite common. It's very experimental, but eventually I think that those systems will harden up. And also that it's possible to enter the stablecoin space via cryptocurrencies like Ethereum in the first place, that those will not be somehow regulated out of existence, which I think is unlikely, but you never know. And lastly, that stablecoins themselves are not securities, which is problematic for regulatory reasons, which again, I won't dwell on. So euro dollars are basically nothing to do with the euro, but a shorthand for thinking of dollars that exist outside of the US banking system, which started in the post-World War II era to basically allow for dollar-denominated transactions that didn't actually require connections to the US central bank. And as Milton Friedman explained in an essay about this, that the major source of Eurodollars is the bookkeeper's pen. That is to say, they're not actually backed by anything. They're basically just created by the institutions that need to use them for trade and creating credit and so on. So some of the features of Eurodollars, for one thing, they're dollars in the sense that that's still the primary denomination for trade and loans and foreign exchange reserves. In principle, you could have synthetic anything, but for the moment, the US is still quite well entrenched as a reserve currency. And they can be used to meet, again, demand when there's not actual dollars available. And we've seen periods where there were extreme dollar shortages, most recently in March coming out of the COVID-19 pandemic. They're not subject to US banking regulations. They exist kind of outside of the US regulated banking space. And one practical use case is oftentimes for citizens of countries that have unstable currencies or unstable governments that are attempting to exchange their currencies for dollars as a way of preserving their value. And some recent examples are Lebanon and Argentina. Now, as far as stablecoins go, stablecoins themselves are still relatively small, even at 15 billion, as Lou said, and we have seen tremendous growth just in the last few months, but they're not yet at the level of Eurodollars that have existed historically. But in a few years, who knows? We could see hundreds of billions of dollars in stablecoins at the rate of growth that we're seeing at the moment. And yeah, so, but the key features of them, and one reason why they're actually better than Eurodollars historically is because they're globally available to anyone, and they can be sent globally instantaneously, as with all crypto. And therefore they can be suitable to various forms of use in trade and payments. They are, of course, still dollars, so they're not necessarily disconnected from US monetary policy, if that is a concern. But I think that this is actually one of the bigger misconceptions in the space right now, that taking inflation, that is to say weakening of the dollar, as a foregone conclusion, which of course there are macroeconomic forces that might initiate inflation, but there are also countervailing forces that are quite deflationary. And notably among them is that the velocity of money has been consistently declining in recent years and may still continue to decline. The pandemic itself is a deflationary event. So the Federal Reserve's providing dollars in the form of liquidity, as to say printer goes burr meme, doesn't ipso facto mean that you end up getting inflation. Unless some of those underlying forces, like the velocity of money declining, were to reverse and those dollars actually make it into the economy, and then of course you can.
Hey, Macauley,
yeah.
To the degree that you've looked at it, what are the causes of the declining velocity?
I think just the growth of technology is one, and to some extent, the overall debt credit fueled nature of a lot of central banks' monetary policies has also not necessarily been successful in getting money into the economy. They actually would like to have more inflation. The Federal Reserve, that is targeting 2%, and it's been consistently below 2%. So yeah, it's a complicated subject, but that's a clear trend.
So to some degree, you're saying, so they're printing more money, but nobody's using it, right? That's part of the...
Right, it's not circulating through the economy, which is what would partly be responsible for generating inflation in combination with the increased supply. but if you're interested in getting away from the dollar, it's good to know, or getting away from the influence of U.S. central bank policy, that at least the crypto collateralized stablecoins are designed to be geopolitically neutral, which is an interesting feature. As far as the world goes, I think that we're still at this point in time a long way from seeing a lot of agreement on what could supersede the dollar as a reserve currency. You have some things like the IMF special drawing rights that has not really taken off, and there are some other ideas like recently the Mark Carney of the Bank of England last year had suggested a synthetic hegemonic currency, but it would take a lot of coordination to actually bring those into reality, and I don't really see that in the near term happening. Okay, let's see. I'm running a long time, so pick it up a little bit. Narrow banking.
You don't have to rush.
Okay. The idea of narrow banking again has a very long history, but a simple way to think of it is a way to park money that is completely safe, in the sense that it's not subject to credit or liquidity crunches, but is just a way to preserve your capital. So I can already imagine some people saying, well, DeFi is definitely not that. And I agree. At this point, it's still very risky. But again, as a kind of a way of conceptualizing it in the future, I think it actually may have some similarities, especially again in those countries where their local currency is already very weak, and they're trying to preserve their value however they can. So today, if you take a snapshot from DeFiRate.com, you get these interest rates. This is the 30-day average, which is always important to look at rather than the current, because they do fluctuate a lot. And yeah, they have, of course, ranged a lot over the past year, sometimes very high, sometimes very low. But still, across the board, the interest rates are considerably better than you can get in the commercial banking and savings accounts at the moment, which, of course, makes it appealing for a lot of people who are trying to earn some interest on their cash. And yeah, it's notable also that you can have an entry into the stablecoin space through any stablecoin and then be able to swap it for another using protocols like Uniswap, which is a decentralized exchange that has been growing by leaps and bounds, and you can see has the majority of the DEX market right now. It's extremely simple, extremely effective, and allows you to move between any ERC20 token, basically. So in the CBDC context, a full reserve bank would be like having a public account at the Fed, which was actually, and this is in the US, of course, which was actually an idea that was floated after the pandemic in March as a way of trying to distribute stimulus. But it's a very complex situation to actually get it up and running. So that was never a realistic proposition, but it did make it as far as some proposed legislation in Congress. And all of the working papers that you see from central banks around the world when discussing the idea of central bank digital currencies that are available to ordinary citizens or businesses, they typically call this retail. They're essentially talking about the same thing. But those are, yeah, going to be the sovereign currency of whatever central bank is issuing them, and they're probably legal tender, although that's not necessarily a given either. And that's quite in contrast to all of the stable coins, whether they're backed by one-to-one reserves of fiat currencies or they're collateralized by something like Ethereum.
Hey, Macauley, because now obviously we're kind of getting into the meat, I assume, of your master's thesis. Which what was the title and what were you setting out to do with the master's thesis?
Well, it was called Stablecoins and Decentralization, and the question that I was asking was, will CBDCs arrive in time? By which I mean that I think the stablecoins and DeFi are legitimate competition for CBDCs that are getting stronger as those plans are further and further delayed. I think none of the central banks other than China is anywhere close to actually issuing a CBDC until 23 or 24, for example, which in our space is a long time. But yeah, right now we have the extent to which there's a parallel with a full reserve bank in something like Maker is the over collateralization. So today, the DAI collateralized overall is over collateralized by 278%, which is quite a lot. And to have DAI as a stable coin, you don't need to take on a lot of the risk that is associated with the crypto space in general, because that risk is taken on by Maker and the holders of Maker as the guarantor of stability. And so you can have confidence that DAI is going to stay within reason relative to its peg to the US dollar. There have been some periods where it's lost a peg quite substantially, and typically it's been riding over $1, but usually it's been within about 2%. So you can use DAI in DeFi protocols without actually worrying too much about the DAI, and how you use it is what is going to determine your risk profile.
So in your view, the fact that it's not as close to its peg as others, you don't view that as problematic?
Well, it's certainly problematic, and they would certainly like it to be better, and they're obviously working to try to make it more closely hew to the dollar. The main difference between DAI, and again, whether you regard this as an important feature or not, sort of depends on a number of factors. But the main difference is that it's not censorable in the same way that the fiat-backed stablecoins are. For example, USDC has had blacklisted addresses as recently as in June, the first one, I think, which is probably not a problem for most people, but ultimately whether or not an address gets blacklisted on USDC is up to a committee of 3 people with majority vote, and 2 of them are executives at Coinbase and Circle. So that is a concern. Also, you are of course relying on the banking access of the stablecoin issuer if it's a fiat reserve-backed stablecoin. Whereas with DAI, you're not relying on that. Of course, you might be relying on and have other risks associated with algorithmic or collateral-backed stablecoins. And then I'm not even talking about yet the algorithmic stablecoins, which are still so new that we don't really know how they're going to work out in the long term. But there are a lot of really interesting projects, some of which have been on previous episodes of your show, that we'll probably be hearing a lot more from in the coming months. Anyway, one of the interesting things that came up in my research was a case in New York called the Narrow Bank versus the New York Fed. And basically this was I'll give you the 30-second overview, but this is a really interesting case. So I would encourage anybody who's interested to go look it up and read the full thing. You can screenshot that, but whoops, that's not what I meant. But the bottom line is that this was a Connecticut state chartered bank that had as its business model only having an account at the Fed, a Fed master account. And then they would take advantage of something called the IOER, which is the interest rate on excess reserves, which for whatever reason has just slightly been higher than the regular federal funds rate. And so they can basically take that tiny fraction of a % of interest and use that as their business model to pass it on to institutions and large accounts of 100 million or more as a way of having a completely risk-free bank, the narrow bank. Excess reserves as a concept have been around for, I think, about 10 or 15 years, I have to check, but they have dramatically increased since March. However, as you can see, the interest rate has actually plummeted now. So in effect, the business model of the narrow bank is in jeopardy, but that sort of doesn't matter because they were blocked from getting a master account by this litigation in New York anyway. Officially, they're awaiting a decision. But the bottom line is that they're not going to get one in the near future. Why it matters is that one of their arguments was that the business model that the narrow bank wanted to do could actually help to nudge rates higher across the board by providing a kind of competition in commercial banking. And that addresses the fact that we see historically that when the Fed funds rate increases, banks are extremely slow to pass on those increased interest rates to their customers. And yet when they are decreasing the Fed funds rate, then they're immediately passed on. So I think there's a quote of someone saying it was sticky on the way up and taking the elevator down. So that was one of the arguments of the narrow bank in the court case, was that maybe this would actually help and be a benefit. But the chairman of the Federal Reserve Board was extremely skeptical, and they termed what the narrow bank wanted to do as pass-through investment entities, PTIs. And he said that the Federal Reserve Board is concerned that PTIs could disrupt financial intermediation in ways that are hard to anticipate. And that is the rationale for them dragging their heels on making a decision about whether or not to give them an account, which is a prerequisite for them to start doing business. So this plays into CBDC in an interesting way, because it underscores a kind of a general fear that the Federal Reserve and other central banks have about offering direct access to central bank money via CBDC, whether it's token or an account. And that, to me, colors a lot of the language of the actual Federal Reserve bankers when they give speeches that have been trending positive, as you can see from this chart from the Bank of International Settlement. They've definitely been coming around to the idea of CBDC in recent years compared to, let's say, 4 years ago, but still seem to me to be extremely skeptical, both for the necessity of it and also for the unintended consequences of implementation. So an example of Jerome Powell, again, talking this time about Fed accounts for the public in the House Financial Services Committee, he very much mirrored the language from the TNB case, talking about how it would be a danger that people might decide to take their money out of banks and put it directly with the Fed to get themselves a narrow bank in effect. And that to me means that it's pretty unlikely that we're going to see a Fed account that operates in a way that would allow people to do that anytime soon, if ever. You can see that, just real quick, deposits are a major portion of the business of banks, of course. And you can find this on YouTube. There's a link, or you can Google it if you want to see all of Chairman Powell's remarks. Lastly, before you plunge headlong into trying to earn 10% on your stable coins, this is a very experimental phase. And just as my PSA, I've seen on so many YouTube channels lately these scams. Maybe it would, if you have ads enabled on yours, I don't know if you do or not, they might even pop up in front of this show. But basically, they're all fake. They're all scams. You never want to send Ethereum to anybody. So anybody who's new to the space should be aware of that. And the latest trend of yield farming is very exciting and fascinating, but it's also quite new and risky. And this is a recent meme that I've come across that's highlighting these experienced yield farmers and what they're doing and how complicated it is. I like this swaps and borrows 13 tokens in a single transaction, which just this morning I was watching a YouTube channel from Nuggets News, and he was talking about this subject with a fellow from Bankless, and they had this Hall of Mirrors effect, which very much reminded me of what the yield farming craze is about at the moment. But isn't that similar to what banking is? Well, in some ways, and they actually made that point. But the difference is that I think, even if we are worried about unintended consequences in the financial system, we also have to be worried about the unintended consequences and potential ways that it can blow up in DeFi. But that said, everybody should get involved and try to experiment, I think, as long as you're not betting your house or are aware that there are significant risks. Anyway, happy to talk with anybody further about any of these issues. You can find me on Twitter at YellowAccount, which is Macauley backwards. I think you actually tweeted to my chess handle, which is Macauley64. That also works fine as well. Oh, okay, that's funny. You got it right, because you were doing chess before you were writing about chess. Yes. And so thanks very much. And yeah, looking forward to your questions.
Okay, thanks a lot, Macauley. And before we go over to Josh, just want to ask you, so what was the biggest surprise to you from when you kind of set out to write your paper to when you finished the paper? Because I assume you had a thesis, and obviously along the way you learned a lot of things.
Yeah, I mean, I expected to find a lot of confusion among politicians about the evolution of cryptocurrency space and stablecoins and DeFi and so on. And I did find that, but I did also find a lot of really thoughtful research from the central banks and from some regulators, which leads me, gives me some optimism that, that there are people who are in positions of power to positively affect the development of the space and try to see the positives and not only the negatives, which is still a big problem from the standpoint of the public.
Makes sense. And last question. You had an interesting chart that showed comments from the central banks, positive and negative. And did the comments from central banks tend to be all of one or the other, or did the same central banks have some positives and some negatives?
I'm not sure how they broke that out by the source, but I think that within central banks there has been a kind of an evolution in the way that they talk about CBDC and the likelihood of and also the actual tangible movement in terms of doing research and pilot projects and so on towards implementing CBDC that has accelerated, and everybody agrees kind of that the trends towards digital currency are accelerating.
Hard to argue with that. Okay, thanks a lot, Macauley. And with that, Josh, I now need to make you a host, and I'll do that in just a moment.
Yes, so I'll start by just kind of giving you guys a little bit of a chat, and then I have a couple. Last time I went into a lot of depth on data and charts and graphs, and I pulled a few because I know Lou loved them last time. But kind of, I think actually interesting based off of what Macauley, went into, kind of the argument I'm going to make.
Just real quick, Josh, you want to tell folks what the tie is for those who don't know?
Yeah, sure. So the TIE is the leading provider of alternative data for digital assets. So we work with a number of different enterprise clients within crypto. We started as really a company focused on sentiment, and we brought with us the only partnership that exists with Twitter. So we have access to the full Twitter fire hose, which is the full real-time stream of 1 billion tweets a day, and we quantify investor sentiment on Twitter. And more recently, we released a product called SigDev, which, for lack of better words, is a product which basically is able to pull in every single piece of disparate information in crypto, whether it be central bank announcements, SEC filings, updates from token issuers, updates from exchanges, and basically create consolidated feeds for a number of enterprise clients to stay on top of the most important and critical events in the space. So we work with everybody from hedge funds to our SigDev product is used by the largest publications in crypto actually to identify news stories. So we're giving the news to the news. For as an example, we work with exchanges and a bunch of other market participants, but very much focused on helping people in this space make more informed, data-driven and information-driven decisions. Wait, Lou, can you hear me? Because I see you're still frozen on my screen. So just want to make sure that I'm.
Yes, I can still. I'm just freezing my video.
Okay, perfect. So one thing I want to really kind of drive into, and this isn't something that I talked about last time I was on the show, is basically the remittance use case of stablecoins. So I think Macauley did a really great job talking about CBDCs, and he hit on a lot of things related to DeFi and yields. So my interest really isn't on the DeFi and the yield generation part of stablecoins, but it's very much on the remittance part of stablecoins. So I am personally of the opinion that a lot of the focus around yields is a good thing, but DeFi presents a tremendous amount of risk. We saw that yesterday with YAM or whatever that token was that existed for 3 minutes and went up by 50,000%, then went down by 99.99% or whatever ridiculousness it was. It was like I was in a meeting and it was worth $1,000 and I left and it was worth 10 cents. But on the other hand, I think that remittance is an incredibly interesting use case. If we look, within the United States, we have apps like the Cash App and we have Venmo and we have PayPal, and we can send money basically instantaneously to one another at almost no cost. But if you look at, globally, as an American, if I want to send money to the Philippines or to Mexico or to another country, it is incredibly expensive. Globally, the average cost of sending a foreign remittance at a bank is 11%, and at a post office, it's 7%. So if you're a foreign worker in Hong Kong, let's say a domestic helper, and you're sending money back to the Philippines and you only have $200 in discretionary income to send back home each month, well, that 11% makes a massive, massive difference for you. And you may be thinking, oh, well, what is, a foreign worker sending $200 home have to do with, cryptocurrency adoption and driving this industry mainstream? That person's $200 really adds up. If we look at remittances globally, there are over $700 billion in global remittances. And global remittances are now actually a larger source of external financing for third world and developing countries than foreign aid is, which just kind of puts into perspective how important remittances are. So we've started to see kind of an improvement in the cost structure of remittances with mobile banking. But if we still look at it globally, it costs 3%, even with mobile banking services, to send money back home. And that just doesn't make any sense. And that's kind of where, I say enter stablecoins. So, when Bitcoin, was originally thought of by Satoshi Nakamoto and was adopted early by Roger Ver and others within the space, there was a lot of discussion about Bitcoin as a means of exchange, right? And what we've seen over time is that the network just cannot scale to support that. And we've seen, solutions like the Lightning Network, which have been built on top of Bitcoin. But for the most part, Bitcoin is not scalable and is not capable of handling, a large scale number of money transfers. On the other hand, stablecoins present a very interesting, solution to that. We did a lot of research on this, unfortunately, a few weeks ago before DeFi decided to become the biggest thing in the entire world, where gas fees were 30 cents a transaction. Unfortunately, we're seeing now Ethereum gas fees being up at about $35 a transaction. So it's still expensive to transfer value on Ethereum. But broadly speaking, stablecoins offer an incredibly, great use case for foreign remittances. A stablecoin will allow somebody in a up and coming, country or developing country to have access to a digital money, which is tied to the value of a advanced economy. So Macauley talked a lot about US dollar backed stablecoins, but a stablecoin doesn't need to be backed by a US dollar. It can, in the case of Libra, there have been different ideas proposed about being tied to a basket of different advanced economies. It can be tied to the euro. It can be tied to anything else. And if you live in Pakistan and you're sending money back home to Pakistan, where the inflation rate in Pakistan is 30%, yes, the Fed might be printing trillions and trillions of dollars, but the inflation rate in the United States is not going to be 30%, right? So with stablecoins, what you can do is you can send money home incredibly fast. The average transaction on Ethereum is 6 minutes. You can typically send transactions back home for an incredibly low amount of money. Gas fees were 30 cents until more recently with this DeFi mania. But I think there are lots of other blockchains, for example, Tron, where transaction fees are very low, that can be used for stablecoin transfers as well. And easily, right? So 24/7, any time of the day, you can send money home basically immediately in a US dollar denominated or advanced dollar denominated currency at almost no cost, as opposed to going to your bank. So if we look at, remittances,
this is probably the first time that Tron has been mentioned.
Well, yeah, look, and look,
show.
I'm not,
and that's fine. Yeah, I mean,
yeah.
I'm open. I generally hear, people more talking about EOS. It probably gets mentioned more as kind of the low cost scalable chain, but obviously Tron's an alternative.
Right. And look, I'm not advocating for Tron. I'm not telling you to invest in Tron. I have my own opinions on Tron. Just the point that there is a sizable amount of Tether which has been issued on Tron. There is Tether which has been issued, there's Omni Tether, which is on Bitcoin. But the point being is that there will be more scalable blockchains, right? There will be blockchains that are created just for transactions and that have smart contracts on them, or that can be built on top of so that you can issue a stable coin on those. And those blockchains offer an incredibly promising solution to foreign remittances because you can send, advanced economy denominated dollars super fast and super cheap, right? And you can do it from the comfort of your phone or from your laptop. You don't have to go walk into a Western Union with your Hong Kong dollars and have somebody, back home in Pakistan or in the Philippines go pick up, Pakistani rupees, for example, right? And so what does that mean for crypto? Well, that's incredibly bullish for crypto because the thing that we've been missing all along is that fiat on-ramp, right? It's the way to bring new and more people into the space. We talked about how crypto is scaling. It's this giant thing. But if we just look at like tweets on Twitter as an example, I just bring that up because that's what, a big part of what my company focuses on. We're still only seeing 30,000 people talking about Bitcoin every day, right? We're still not mainstream. We are definitely getting there. We are getting closer, but we're not there yet. With stablecoins, if we make it easier for foreign domestic workers, the tens or hundreds of millions that exist globally to send money back home cheap and easy, well, all of a sudden we're opening this fiat on-ramp. We're entering all of these people into crypto, and they're bringing hundreds of billions of dollars into the space, right? And what we've seen historically is that people start with Bitcoin, but then they go down this rabbit hole of trading other digital currencies, right? They start with Bitcoin, then they start trading Ethereum, and then they somehow ended up with yams, right? And trading on Uniswap and trading Chainlink and all these kinds of different things, right? And so if we can capture 1% of the global foreign remittance market, that's $7 billion new dollars in stable coins, which are being generated each year. And once you have a stable coin, you become more comfortable with working with a cryptocurrency exchange, right? You get more comfortable with the idea of a digital dollar. And I think the idea of Bitcoin, for example, as a digital gold makes more sense. And so there's another idea which I want to highlight, which is the FAT protocol thesis. And that was proposed by Joel Monegro, who was at Union Square Ventures about 5 or 6 years ago. And the idea basically being that when the internet first emerged, all the value didn't accrue at the protocol level, right? It didn't accrue at the TCP/IP, HTTP layer. It all accrued at the application layer. It accrued to your Googles and to your Yahoos and to your Ask Jeeves back in the day and your AOLs. Within crypto, what we've seen to this point is that the majority of the value is accruing to the protocol level. If we look at basically up until today, the top 5 cryptocurrencies by market cap have always been protocols. It's been your Bitcoin Cashes and your Ethereums and your EOSs and your Trons and back in the day, a number of other digital currencies, but they were all protocols, not applications. We are starting to see a change in that, right? We're seeing now Chainlink just entered the top 5, surpassing Bitcoin Cash, and that's an ERC20 token built on top of Ethereum. But we still kind of are seeing that a lot of value is accruing at the protocol level. So if we believe that value will accrue at the protocol level, well, then that's a bullish, sign for Ethereum and for other, for EOS, as Lou mentioned, for these other blockchains, that if a number of stable coins get issued on top of these blockchains, if we see, stable coins start to take hold and we see, more transactions built on top of these, blockchains using stable coins, well, if you believe or are a proponent of the FAT protocol thesis, well, then, there will be a tremendous amount of value driven to those, to those different protocols. So basically the general idea is it's super expensive to send money globally. Stable coins can solve that. They will solve that. It will bring a tremendous amount of capital into this ecosystem, and that capital will flow to these protocols, into these applications.
Okay, terrific. Did you want to share some of the data as well?
Yeah, I have some data. So my data is actually a little bit different. Last time I talked about the craziness of stablecoin mania, I kind of just wanted to highlight how crazy DeFi mania has got, because I think it's relevant to crypto. If we look, this chart here looks at the relative mentions of stablecoins versus DeFi. I mean, blue line is DeFi. This is mentions in publication headlines. DeFi is seeing this absolute surge. And I think, to Macaulay's point earlier, that will be bullish for stablecoins because a lot of stablecoins are being used in DeFi. but just interesting to see how fast crypto narratives change. Because when I was on, I think episode 3 a couple months ago, you know, it was stablecoins, and now it's DeFi, right? And just kind of interesting to show how that changes. And you know, we're also seeing a slight dip, not a significant dip, but a slight dip in the average tweet volume, which is that dark blue line of Tether, as well as the market cap dominance of Tether. So we saw, you know, in, you know, the early, you know, the first half of this year, you know, Q1 through Q2, this massive rise in stablecoins, this massive rise in conversations around stablecoins. But you know, one, because other cryptocurrencies are just surging in value, that's inherently going to reduce the value, or you know, the dominance of stablecoins in terms of the overall crypto market cap. But we're also seeing quite a few less conversations around stablecoins, and we can compare that to a cryptocurrency like Chainlink. And something absolutely wild we saw is that Chainlink now accounts for 2,500% larger amount of crypto's market cap, and even more than that in terms of Twitter volume versus 2 years ago. So just kind of wild to see this, you know, this quick switch into DeFi that we're starting to see. But stablecoins are clearly going to have some role, or I think a very large role in that.
When you were talking about, so thanks for that. When you were talking about the role that stablecoins could play in terms of onboarding, have you thought much about, you know, the role? Do you think of central bank digital currencies as stablecoins, and if so, you know, the role that they can play in that onboarding process?
Yeah, I mean, I think having native digital token, right? Like right now, if you want to take cash and you want to put it on an exchange, it is expensive. Like if you want to take your US dollars and put it on Coinbase, it is not cheap. If you want to take cryptocurrency and you want to convert it into you know, fiat, it isn't cheap. But native digital tokens are cheap, right? It's very easy to convert your Tether into Bitcoin. You can do that on plenty of exchanges for 3 basis points or 5 basis points. So I think that having any native digital currency built on top of any blockchain that can easily be integrated into an exchange, whether centralized or decentralized, you know, presents a very, you know, it makes it significantly easier for people to buy cryptocurrencies. Can you imagine if everybody's, you know, stimulus check from the government was denominated in Tether or in a cryptocurrency? Every single person would have put it into Bitcoin. But what they had to do is they had to take it from their bank. They had to wait 3 days for their bank, for the money to get from the government to their bank. And they had to wait 3 days for the, you know, the money to get from their bank onto, you know, Coinbase. Then they had to buy, you know, Bitcoin on Coinbase. And then if they wanted to go to a decentralized exchange, let's say they bought Ethereum, then they'd have to take that Ethereum and put it in a wallet. Then they'd have to take that wallet and bring it to a decentralized exchange. There's just too many steps in this nonsensical process. And the more digital we get, the easier it gets to transfer capital.
Undoubtedly.
Just jump in. I had to wait 2 months for a paper check here in Germany, which also by itself is kind of ridiculous. But thankfully, I could deposit it via a mobile phone app rather than having to mail it back to the U.S. to be deposited by a family or something.
Right. Yeah, but I mean, it's crazy, right? An Ethereum transaction takes 6 minutes. It takes like four weeks for the government to send you a stimulus check, right? Like.
Yeah. But on Ethereum, you don't get a check signed by Donald Trump. So
you don't. We know that. We all want that.
Valuable souvenir.
Okay, so thanks, Josh, for that. Thanks for sticking around for the Q&A. And we've got our first question from Miklos. Miklos?
Hey, guys.
Hey, how are you? We can hear you, Miklos.
Hey. Thank you for the valuable presentation. I am Mike from Collion Foundation and Collion X. So we are supporting the stablecoin adoption and everything around stablecoins. So really enjoy your profession. My first question is to my colleague that how do you see that the reserve behind the CBDCs? So what kind of assets could be the reserve? Will be the debt-based system that we have at the moment with the fiat system, or we will see some gold or other tokenized assets backing CBDCs or maybe Bitcoin. So how do you see this CBDC reserve system?
Yeah, I mean, I should say I'm not an economist and haven't delved into that question in any depth, but I can say that I did not encounter in the public discussions regarding CBDC very much in the way of talking about, yeah, asset-backed, hard asset-backed currencies. Now, of course, it is interesting to note that in the US, Trump's recent nominee to the Federal Reserve Board is, is on the record as being a bit of an advocate of the gold standard, although for political reasons kind of backed off on that when she was actually being nominated and going through Senate confirmation, but eventually did get confirmed. These things obviously can change, but I don't think, if I had to take a guess, I don't think that's likely. The CBDC should be thought of as being essentially equivalent to cash. And as if it's going to be legal tender. In fact, one of the interesting discussions about how CBDC could work is related to privacy, because obviously there's an interest both among policymakers and among the public of being able to preserve some of the cash-like features, which on its face is difficult, but there are some technical solutions to doing that. And the question is how to reconcile those privacy features with the concerns over money laundering and terrorist financing, which inevitably will crop up as well as these things get closer to implementation.
Thank you.
Okay, thanks, Miklos. We've got our next question from Peter Davey. Peter?
Oh, hi. Yeah, sure. You're saying about Joshua, about the costs of remittances and how high they were and all that sort of stuff, and how easy it would be, using stablecoin. But I mean, looking at the way FATF, Financial Action Task Force, is so doggedly sort of saying that, the stablecoins specifically have to go via a VASP, and VASPs have to comply with the wire transfer regulations, basically pass the ultimate payer and ultimate beneficiary information all along the transaction, and basically screen it for sanctions and everything. Aren't they going to inherit exactly the same cost structure as your payment service provider? And so isn't there the risk that benefit will evaporate pretty quick?
Well, look, I mean, the idea behind cryptocurrency has always been decentralization, right? And removing these government barriers, right? And removing, a lot of this centralization and regulation as it relates to, moving capital and holding your own keys, right? And keeping those separate from governments. And I think, what stable coins present is a, potentially a decentralized solution for moving money. And the thing about Bitcoin is governments can't shut down Bitcoin. What they can shut down is the fiat on-ramps, which bring capital into the system. But with any sort of decentralized, stable coin or currency, or even with centralized currencies, which in many cases are operated out of, quite arbitrary countries, I think that you're able to get around a lot of that. I think that governments may start to put up a fight if a lot of this happens. But I do think that if you're a domestic helper in Hong Kong and you can go online and you can send somebody $150 in Tether back home, I don't think that some sort of government regulation is necessarily going to stop you from doing that.
Yeah, just on that point, I don't know if you have the number off the top of your head, but the average remittance transaction is probably a relatively modest amount, right? So
yeah, I don't know the exact number, but I would assume
it's probably less than 10,000. So the FinCEN.
Oh, it's definitely not half thousands.
Yeah, significantly less. So the FinCEN requirements for that are focused on money laundering and counterterrorism kind of kick in above a certain threshold. So maybe that doesn't practically become a problem for remittances as a use case. And once you're within any of the stable coins, also you can of course switch into any other one that may be regulated in different jurisdictions or not at all. So yeah, there probably is a combination of regulatory and technological solutions to that basic problem. And the question is, how will governments be able to balance those concerns?
Yeah, you are seeing the government's trying to do something about it, and the big thing is that terrorism is super cheap. You know, it's not talking about you need $1,000. I mean, you know, the sending the bombs from Yemen to the UK to you know, cost next to nothing.
I mean, and I mean, what we are seeing is that, as much as people like to claim that cryptocurrencies are anonymous, Chainalysis has done a great job at, and Elliptic and some other companies that exist within the digital asset space have done a great job in cracking down on terrorism. And I don't know if you saw it today, but the Justice Department just announced the biggest seizure of cryptocurrency ever from terrorist activities. They did that in partnership with Chainalysis. And so there are ways that you can use on-chain transactions, and you can track the flows of cryptocurrency to stop a lot of that, which I think is separate from a poor foreign worker who's trying to send $30 back home and make sure that, their family doesn't get 27, they get $30.
Okay, thanks.
Okay, thanks, Peter. And just real quick, just following up a little bit on that, Macauley, in the work that you did, what we're now seeing with the decentralized versions, notably Maker, obviously with USDC, they've got to take $1, put $1 in the bank to create the stable coin. But Maker is really kind of creating dollars out of thin air to some degree. I mean, you've got to lock up some asset, but there didn't used to be $1. Now there's $1, and now the round figures are about 400 million of them. Do you think that governments, or particularly the U.S. government, is going to have a problem with that if it gets too large?
I think it's pretty likely, yeah. And of course, there's a debate about to the extent to which Maker is really decentralized at this point, or still has a lot of centralized features. Of course, the long-term goal is for it to be decentralized. So yeah, I'm assuming that it will get to where it wants to go. One interesting thing about DAI and Maker is that it's, again, it's not as susceptible to the direct control of the Federal Reserve Bank, because it doesn't have this banking system requirement. But just as if you're concerned about US monetary policy vis-a-vis the dollar, with any stablecoin, the fact that you can swap them into any one you want in seconds, again, assuming gas fees come down, should alleviate any kinds of concerns. In other words, it can provide a check on monetary policy generally once there are stablecoins that are denominated, as Josh said, in other currencies. If you get too concerned about inflation, you simply can easily switch to another currency in a way that's not practically so simple today.
Or gold.
Yeah, I mean, very fluidly. I mean, it'll become like translation. On the fly translation, sort of on the fly currency as you wish. That's one of the more exciting features about it. But yeah, DAI itself, of course, because it has this over collateralization requirement, there's some practical limitations on how it can scale, because it has to have assets backing it, which is one reason why they're so focused now on trying to onboard more and more assets, including real world assets, cash flows from businesses, for example, so that they can try to expand the total base. But pretty much as a user of DAI, you don't have to worry about any of that, because all of that is Maker's problem. As long as you have confidence, that they're able to maintain the peg, you can use DAI as you want as a dollar equivalent, freely.
One thing I want to add to what you're saying, Lou, about our government's going to start to care. I'm literally looking at a sources sought announcement from the SEC right now on digital asset market intelligence, and there's a giant section of it of the SEC looking for somebody to help them track decentralized finance.
Yeah, they want to know what's going on. That is for sure. Okay, our last question for episode number 11 is from Ganesh. Ganesh?
Hi, everyone. I'm a researcher at Warwick Business School, and I'm researching stablecoins. So my question to Macauley, so I thought the narrow banking example was quite interesting. I just wanted to get a bit of clarification on how the introduction of a CBDC will be similar to a narrow bank. And I also wanted to hear your thoughts on whether you think a retail or a wholesale CBDC is the better option. And to Joshua, so I think remittances is a very interesting use case. I was curious, is there any source out there that gives you a proxy for how much stablecoin activity is being used for remittances, and also whether there's like data on like geography of these flows? That would be very interesting.
So the parallel with the narrow bank would be as far as what the individual user, in the case of a retail CBDC, or the large institution or fund that wants to use the TNB USA bank and charter, if it actually ever gets up and running, is simply to take away a lot of risk. So if you're holding your money directly with the central bank, you eliminate basically all kinds of risks that currently people have, even if they're small, with commercial banks. And the main connection with CBDC that I see is that the way that they talk about this potential, is something that they're definitely concerned and maybe even fearful of, and being something that could potentially threaten financial stability if people do make that choice. So I think for that reason, it's very unlikely that we'll actually get retail CBDC in, at least in some of the larger currencies of central banks. Maybe there will be some countries that will try it, and then we'll see how it works out in practice. But my sense is that the wholesale CBDC is far more likely, because that way they can actually carve out a business model for commercial banks to participate in the CBDC ecosystem in a way that the policymakers will find important to do, and probably they'll have a lot of political donations behind making sure that happens as well. As far as the users go, I think they're going to have some say, and the public will have some say too. And it's a question of how will it all shake out? But yeah, economically, I think there probably are differences as well, whether you have a retail CBDC or a wholesale CBDC, and maybe those end up getting managed by having a kind of a hybrid where you have some tokenized CBDC that works in the function of cash, but is limited to certain amounts. That also could address some of the AML and counterterrorism concerns. And then for larger amounts, you still have a relationship with commercial banks, for example.
Thank you.
And yeah, so to your question, which was on, I think, the geography of transactions, and I see another question in there on the amount of remittance payments using stablecoins. So I don't know if there's an exact way to gauge that, because of the fact that we don't know if a payment from one place to another is necessarily a remittance. But there are a couple of useful tools. The first is there's a website called usefultulips.org, and that tracks local Bitcoins and Paxful volume. And obviously that's not stable coins, but that is just geographic flows of cryptocurrency. Chainalysis also just put out a new report on the geography of cryptocurrency, which is quite interesting. I think the best way to gauge it would be using some sort of analysis of wallet addresses, looking at they're active, to see where, to kind of best guess where that wallet address is located, and to see where the funds are flowing to. And you could probably come up with some sort of a good gauge, but it's, because of the fact that we don't know who owns what wallet address, there's no centralized entity that's tracking this. It's very hard to get an exact number, but I think there's ways to kind of guesstimate it at this point.
Okay.
Thank you.
Great. Thanks for the question, Ganesh. And I'd like to thank our panelists, Macauley and Josh, for joining us on episode number 11. We've got a great show next week on episode number 12, including DeFi Dollar, which is a stablecoin of stablecoins from India, and Cello, which is a super exciting stablecoin project that's going to be coming out shortly. So again, thanks, Josh. Thanks, Macauley. Thanks, everybody, for joining us. See you next week.
Thank you. Bye.